Is the QQQ ETF your golden ticket to massive portfolio growth in 2026, or a tech-heavy time bomb that's getting ready to blow up? It's crushed the market for years, but with tech valuations in the stratosphere, a lot of investors are quietly asking, are we in a bubble? QQQ is dominated by giants like Apple, Microsoft, Nvidia, and Amazon, the engines behind modern innovation. But heading into 2026, the real question is QQQ still the best growth ETF? Or has big tech become too expensive and too concentrated to be safe? In this video, we're going to break it down properly. What QQQ actually holds, how it's performed in both bull markets and crashes, the real risks most investors underestimate, and whether it still deserves a place in a long-term portfolio. By the end, you'll have a clear data-backed answer on whether QQQ should be your growth ETF for 2026, or if you're better off looking elsewhere. Let's get into it. So, what exactly is the Invesco QQQ Trust, better known by its ticker, QQQ? At its heart, QQQ is an exchange-traded fund, or ETF. Think of it as a basket that holds a bunch of different stocks. Instead of you having to buy 100 companies one by one, you can buy one share of QQQ and instantly own a piece of all of them. But this isn't just any basket of stocks. QQQ specifically tracks the NASDAQ 100 index. This index is made up of the 100 largest and most actively traded non-financial companies on the NASDAQ stock exchange. Those are the key words, non-financial. This means you won't find big banks or insurance companies in QQQ, which is a major difference when you compare it to broader funds like those tracking the S&P 500. This basket of stocks is heavily tilted towards the technology sector. As of late 2025, the official allocation to information technology is around 64% of the fund. But as we'll see later, the real tech exposure is even higher. This gives you massive exposure to the engine of modern innovation. And speaking of what's inside, buying QQQ is like owning a who's who of global tech and growth. While the exact order shifts, the top holdings as of early December 2025 are dominated by giants like Nvidia, Apple, Microsoft, Broadcom, Amazon, Alphabet, and Meta platforms. These are the companies at the forefront of everything from AI and cloud computing to e-commerce and streaming. One of the most important stats for any ETF is its cost-to-expense ratio. As of late 2025, QQQ's expense ratio is 0.20%. This means for every $10,000 you invest, you pay $20 a year. Now that's way cheaper than old-school mutual funds, and while not the absolute lowest on the market, it is seen by many as a reasonable price for the specific exposure it offers. Finally, QQQ is one of the most traded ETFs in the world. Its high liquidity means it's super easy to buy and sell, and it has a very active options market, making it a favorite for both long-term investors and short-term traders. So simply put, QQQ is a one-stop shop to invest in 100 of the world's biggest, most innovative non-financial companies with a heavy, unapologetic focus on technology. Now for the part that made QQQ famous, its performance. For years, this ETF has been an absolute powerhouse, and the numbers speak for themselves. When you compare QQQ to the S&P 500, often tracked by ETFs like SPY, the difference is pretty stark. Over long periods, QQQ has significantly outperformed the broader market, particularly during technology-driven bull markets. Let's make this real by looking at three simple investing scenarios. Scenario 1, lump sum, 10 years ago. Starting with a traditional approach, if an investor put $10,000 into QQ about 10 years ago, that investment would be worth roughly $58,500 today. Over the same period, a $10,000 investment in SPY would have grown to around $39,000. That alone shows why QQQ has been such a powerful growth vehicle over the past decade. Scenario 2, lump sum, GFC low, March 9, 2009. Now let's zoom out further. If an investor had the courage, or simply the luck, to invest $10,000 at the market bottom during the global financial crisis on March 9, 2009, the long-term impact becomes even more dramatic. From that point through late 2025, that single $10,000 investment in QQQ would have grown to around $277,000. By comparison, the same $10,000 invested in the S&P 500 would have grown to roughly $139,000. That gap highlights how the long-term bull market in technology and innovation has compounded over more than 16 years. Scenario 3, daily investing, consistency over time. But most investors don't invest perfectly at market bottoms. So here's the more realistic scenario. If instead of timing the market, an investor simply invested $10 per day, every day, starting from that same March 2009 low and continuing through late 2025, the total amount invested would have been about $42,100. That steady, disciplined approach would have grown into approximately $265,000 in QQQ, compared with around $164,000 in an S&P 500 fund. No perfect timing, no leverage, just consistency and time. This performance is driven by the nature of the NASDAQ 100 itself. The companies inside QQQ aren't just growing, they're often dominating their industries and defining what's next. They reinvest aggressively into innovation, which compounds earnings over long periods. However, this kind of performance has never come without volatility. Even across this powerful bull market, QQQ experienced sharp drawdowns and uncomfortable periods along the way. And that leads us to the key question heading into 2026. Can investors actually stay invested long enough to capture this kind of long-term growth? All right, we've seen the incredible growth story of QQQ. But before you even think about going all in, you have to understand the risks, because this ETF is not for the faint of heart. And for 2026, these risks are more relevant than ever. The biggest risk is concentration risk. QQQ isn't a broadly diversified fund. It's a concentrated bet on a specific group of companies. Officially, the information technology sector accounts for nearly 65% of the fund, but that number is arguably misleading. When you reclassify giants like Amazon and Tesla, which are officially listed under consumer discretionary but are tech powerhouses in their own right, the expanded tech exposure takes a lion's share of the fund, approaching nearly 75%. Even more, its performance is massively dependent on just a handful of mega-cap stocks. As of late 2025, the top 10 holdings alone make up over 50% of the entire fund. This means if a few of those top dogs, like Apple, Nvidia, or Microsoft, have a bad year, QQQ is going to feel it in a big way. Your investment is tied to the fortunes of big tech. If that sector stumbles, so does your portfolio. This leads right to the second major risk, higher volatility. Compared to a broad market fund, QQQ has much bigger price swings, both up and down. When the market loves tech, QQQ soars. But when that love fades, it can fall harder and faster. The history is clear. During the dot-com bust, the underlying NASDAQ 100 index fell a jaw-dropping 78% from its peak in 2000 to its low in 2002. More recently, it saw major drops during the 2008 financial crisis and the 2022 bear market. An investor in QQQ has to have the stomach to watch their investment drop sharply at times and the patience to wait it out. The third risk is its sector bias. Because QQQ tracks the NASDAQ 100, it completely leaves out major parts of the economy. Most notably, it has zero exposure to traditional financial companies like big banks. It also has very little exposure to sectors like energy, materials, or utilities. This means if those other sectors are having a great year while tech is struggling, QQQ will likely underperform the broader market. You're missing out on potential growth from other key areas. Finally, there are valuation concerns. The innovative, high-growth companies in QQQ often trade at sky-high valuations. Investors are willing to pay a premium for their future growth, but this makes them vulnerable when the market gets nervous or when interest rates rise, as future profits become less valuable. If market sentiment shifts from growth to value, these expensive stocks can be the first to get tossed overboard. For 2026, after such a strong run for tech, these risks of concentration, volatility, and high valuations should be front and center in every investor's mind. So, we come back to the big question. Is QQQ the best growth ETF for your portfolio in 2026? Here's the honest verdict. QQQ is still an elite, top-tier choice for a specific kind of investor. It's arguably the best fund for someone who wants aggressive, concentrated exposure to the world's most dominant tech leaders and who truly believes these mega-cap companies will keep driving the market. Its long track record, huge liquidity, and pure play focus on the NASDAQ 100 are unmatched. If you want a fund that is unapologetically all in on big tech, QQQ is still the king. However, QQQ is probably not the best growth ETF for everyone in 2026. If your main goal is to build a portfolio with the lowest possible costs or with wider diversification across different market sectors, QQQ may not fit that objective. Its 0.2% expense ratio, while competitive, is higher than some other broad market funds. And its tight focus on the NASDAQ 100 means you are making a concentrated bet, foregoing exposure to other sectors of the economy. Think of it this way. QQQ is a high-performance vehicle. It's powerful, fast, and thrilling, but it's more expensive to run and can be unforgiving if you hit a patch of bad road. It's designed for a specific purpose: aggressive growth. Investors who prioritize stability, broader market exposure, or the lowest possible fees might find that a different strategy is more suitable for their long-term goals. So if you decide QQQ is for you, how should you use it? Most financial experts would advise against making it your only holding simply because of its lack of diversification. Instead, a popular and smart strategy is to use QQQ as a growth booster alongside a core diversified portfolio. For example, a common setup is to put 80% or 90% of your money into a low-cost S&P 500 ETF like VOO or SPY, giving you a solid foundation across the whole US market. Then, you can allocate the other 10% or 20% to QQQ to add that extra spice and potential for higher growth. This core satellite approach gives you the best of both worlds: the stability of the broad market and the high-octane potential of the NASDAQ 100. Another great strategy, especially with QQQ's volatility, is dollar cost averaging. This just means investing a fixed amount of money at regular intervals, say $200 every month, no matter what the market is doing. When the price is high, you buy fewer shares. When the price is low, you buy more. This smooths out your average cost and saves you from the emotional roller coaster of trying to time the market. Ultimately, QQQ is best for investors with a long-term time horizon, at least 5 to 10 years, if not more. This gives you enough time to ride out the inevitable storms and capture the long-term growth of the amazing companies it holds. All right, let's land the plane. The Invesco QQQ ETF is a legend for a reason. It offers pure, concentrated access to the innovation of the NASDAQ 100, and its historical performance has been spectacular. But it's not perfect. Its heavy concentration in tech, higher volatility, and relatively higher fee are real risks every investor needs to weigh, especially heading into 2026. For aggressive long-term investors who get those risks and are comfortable with them, QQQ is still one of the best tools out there to supercharge a portfolio. For many others, though, its specific focus and cost profile might mean a different approach to growth investing is more prudent. Now, I want to hear from you. Is QQQ part of your game plan for 2026? Are you buying, holding, or looking at something else? Let me know your thoughts in the comments below. I read every single one. And if you got any value out of this breakdown, do me a favor and hit that like button and subscribe for more deep dives into the investments that can help you build long-term wealth. Thanks for your time, and I'll see you in the next one. This video is for educational and informational purposes only and does not constitute financial advice. All investing involves risk, and past performance is not indicative of future results. The examples shown are for illustration only and are based on historical data. Always consider your own financial situation and objectives, and do your own research or consult a licensed financial professional before making any investment decisions.